Welcome to BD Daily Finance News Podcast, your daily briefing on finance and investing. I'm your host, and today is 2026, August 7th. Stocks are leaning higher before the U.S. jobs report. Big tech has remembered it loves AI, and oil is doing that dramatic thing where it makes every budget spreadsheet sweat.
I'm your guest, and I brought coffee because the market brought chaos. We have AI euphoria, oil anxiety, China trade strength, and a utility merger where your electric bill may be the surprise villain.
Story 1. Bloomberg reports stocks edged higher in subdued trading ahead of the key monthly U.S. payrolls report. Traders are watching jobs data for clues about the Federal Reserve's policy path, and CNBC noted expectations for July payrolls around 83,000, with unemployment unchanged near 4.2%.
So the market is basically waiting for the economy's report card, except instead of parents signing it, Jerome Powell may adjust interest rates. A weak jobs number can make rate cuts look more likely, but too weak, and investors start whispering recession like it's a ghost in the hallway.
Exactly. The simple version is this. Strong hiring can keep inflation pressure alive, while softer hiring can support the case for lower rates. For normal people, it affects mortgage rates, credit card costs, job security, and whether your portfolio gets a tailwind or a reality check.
Story 2 is the return of the AI hype machine. Bloomberg says big tech stocks are storming back as fears about heavy artificial intelligence spending fade and market euphoria resumes, which is Wall Street's way of saying, sorry we doubted the expensive robots.
Earlier this year, investors worried tech giants were spending too much on AI infrastructure, chips, data centers, cloud capacity, the whole digital gym membership. Now the mood has flipped because markets are again betting those investments can drive revenue, productivity, and competitive advantage.
I agree with the opportunity, but I disagree with the victory lap. If a stock price goes up because people are less scared, that is not the same as proof the spending will pay off. That's not investing. That's emotional cardio in a blazer.
Fair pushback. The actionable takeaway is not to chase every AI headline. It's to check concentration risk. If your retirement account already owns broad U.S. indexes, you may have plenty of big tech exposure without buying an extra ticket to the hype parade.
Story 3. CNBC reports oil prices rose after news that Iran's draft plan could restrict U.S. and Israeli access connected to the Strait of Hormuz. Translation: one of the world's most important energy choke points is back in the market's group chat, and it is typing in all caps.
Oil matters because it flows through almost everything. Gasoline, shipping, air travel, plastics, fertilizer, and inflation expectations. If supply risk rises, crude can move higher, and that can complicate the Fed's rate cut hopes we just discussed.
So oil is the friend who shows up late and somehow makes everyone split the dinner bill differently. For households, this means watch commuting costs, travel plans, and companies with heavy fuel exposure. Airlines and delivery firms do not run on positive vibes.
Story 4. CNBC says Virginia's governor plans to intervene in the review of a NextEra and Dominion merger over electricity price concerns. The state regulator can accept, reject, or impose conditions, and the backdrop is rising power demand from data centers.
This is where AI leaves the cloud and lands on your utility bill. Everyone wants smarter software, but those data centers need electricity like a teenager needs phone battery at 3%. The finance angle is regulation, pricing power, and who pays for new infrastructure.
Story 5. South China Morning Post reports the AI trade revival is improving the outlook for Chinese tech stocks after record sell-offs. The Star Market 50 closed the week up 6.6% after a 26% July slump, while China trade data showed July exports up 23.9%, imports up 27.5%, and a trade surplus of $112.5 billion.
That is a big rebound, but I am not ready to put confetti in my brokerage account. A 6.6% bounce after a 26% drop is like finding a coupon after your roof leaked. Helpful, yes, Fully repaired? Absolutely not.
Still, the signal matters. AI demand is supporting chips, components, servers, logistics, and exporters. For investors, the opportunity is global supply chain exposure, but the risk is policy shocks, tariffs, currency moves, and volatility that can turn a clean chart into spaghetti.
Let me recap like a responsible adult pretending not to panic. Jobs data guides the Fed. AI stocks are hot again. Oil can revive inflation pressure. Power bills may become the hidden AI tax, and China's tech trade is bouncing, but not risk-free.
Your practical checklist. Keep emergency cash, avoid overconcentration in one theme, review energy-sensitive expenses, and compare your portfolio's AI exposure before adding more. This is education, not personal financial advice, but discipline beats headline chasing most days.
If this helped, subscribe to BD Daily Finance News Podcast. Like the episode, and tell us in the comments, are you more worried about oil inflation or AI overvaluation? I will be reading the comments while pretending my electric bill is not judging me.